Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian equities gain on the back of a tech-fueled rally on Wall Street, but there are concerns that the Fed may be less dovish than previously expected with rates. Bloomberg learns that Couche-Tard is thinking of sweetening its takeover offer for Seven & I Holdings, sending shares surging. And Paul Marriott, president of Asia Pacific and Japan at software maker SAP, joins us with how AI is changing the enterprise software business. First, though, let's check in on how markets are faring. Avril Hong's in Singapore, and Avril, looks like most markets are doing pretty well today.
Yeah, we're seeing the region's benchmark surging 1+%. This could be its first positive close this week. And of course, it's being helped along by the tech sector after those comments from the Nvidia chief highlighting how limited supply and there's strong demand for its chips. So the chip names in the region are among the biggest boosts for the stock benchmark. We are also continuing to digest that US CPI print, right? Hotter than expected on the core CPI, and traders pretty much erasing their bets of 50 basis points from the Fed next week. We're seeing yields on the US 10-year continuing to climb in the Asia session, a bit firmer on the US dollar, a bit of pressure given the shifting Fed expectations as well as the rate gap on some of these Asian currencies. Certainly in the yen, take a look at this chart that will show you how it has been performing in the past couple of hours, actually extending declines after PPI print that was slowing for the first time in 8 months. And then we got some comments from a BOJ board member sounding pretty hawkish. This is a known hawk, but Tamura pretty much saying that the neutral rate is at least 1%. Flip the board again, take a look at what we're getting in terms of Fed futures and swaps, what they're pricing in. As I say, traders are erasing those 50 basis point bets. And indeed, if you look at this, this is the closest that they've been pricing in, a 25 basis point reduction in 3 weeks. 3 weeks, because that was 3 weeks ago when Powell spoke at Jackson Hole and he made those "the time has come" comments. Now let's bring in our first guest, Teck Ling Tan, APEC FX and macro strategist from UBS Wealth Management. Also with us is Bloomberg MLive executive editor, Mark Cudmore. Mark, let's start with you first. So we have those US CPI numbers. Do you think this gives enough for the hawks, that it raises all chances of a 50 basis point cut next week?
Well, I'm biased because I thought it was always ridiculous we're ever considering a 50 basis points rate cut. I don't think the US is close to recession yet. Obviously, it never looks like a close to recession until you're actually in one. But I still have always thought that the rate cuts are kind of overpriced. And I'm glad that CPI kind of came out to kind of validate that view. So with that bias said, what I do think is interesting is that we should be set on 25 basis points. Almost all the Fed members have guided towards 25. The data doesn't justify more than 25. The only reason we still have a slight chance of 50 is the single most important person in this decision, Chair Jerome Powell, does seem inclined by 50. And that's why I still think they'll do 25. I've always thought they'll do 25. But I acknowledge that there is a risk when there shouldn't be a risk. We should be certain by this stage.
Okay. Teck, you think it's also going to be 25, right? And you see 100 basis points by the end of the year. In terms of timing, what does that mean, though? Because does that mean 50 is going to come in December? I don't think the Fed is going to do 50 around the time of the election.
Yeah, so I think that's a tricky one because the data as it comes in shows that September is likely to be a 25 unless retail sales were to surprise on the downside. But having said that, if September is a 25 and we are calling for 100 this year, right, there is somewhere a 50. Now, it could also be November after the election, given that if we were to count, there are 3 meetings over 4 months. September 25, for example, then there is none in October, and November could be a 50 simply if you do a linear calculation, right? So it could be that way. It could also be that they want to front load the messaging, even though 25 is what the market is pricing. But I think to the point that Mark made, if you imagine that the Fed has pretty much achieved its objective, and the policy restrictiveness is as high as it is now, there is also a case that they make a 50 first, just to show that they are in the process a bit more on track, and then after that they can just do a 25 meeting after meeting.
Tech, I just wonder how difficult it is forecasting the future path of Fed policy after the election, considering the aggressive spending plans of both candidates. Do you feel that there is a risk that inflation could reignite in 2025?
Yeah, I think both candidates, as you mentioned, they are going to spend more and they are going to expand the fiscal deficit. I think under the Trump scenario, it could be slightly more inflationary to the extent that the trade tariff would add an additional factor. But having said that, I think the economics of it, if you look at the dynamics, labor market is cooling. Inflation is partly helped by oil prices, which is actually fallen to $70. I think we are still of the view that inflation should be trending towards 2 to 2.5. That shouldn't actually complicate the fact that the Fed funds rate is sitting above 5%, and just moving closer to the neutral rate. Longer term, it should be closer to 3% rather than 5%. It shouldn't actually interrupt the idea that the Fed can actually systematically cut.
Mark, I just want to get your views on that as well. I mean, what is the path of inflation in 2025? Because there is this huge uncertainty around what the election result brings in the US.
So obviously, we break down quite simply into services inflation versus goods inflation. I think services inflation remains sticky, and I think it'll remain sticky until the labour market is properly broken. We've seen the labour market cool but not break. So I think there's a sticky component there. I think on the goods inflation side, it is much more of an economic growth story. I'm simplifying here, but this is the 2-minute answer. And because I'm pretty optimistic on the economy, I think that also stays a little bit more positive than people think. Though at least we're helped by what's happening in energy sides, commodities space. So that means I am someone who thinks that actually most of the disinflationary trend has played through already. And until we get some severe growth slowdown, I actually think we're going to get more worried by inflation again. And I slightly worry that if we get another inflationary bump up next year, i.e. via the kind of the Trump policies that were suggested, then I worry that it's not necessarily net positive the dollar, because it might be inflation that the Fed feel they can't fully counteract with rate hikes because they're getting more worried about the economy at that stage. So I think we're going to continue to be worried about inflation next year, even though at the moment, all we care about is the jobs market.
Tech, how would you suggest positioning amid this?
Yeah, I think it is interesting because on one hand, we are arguing that the US economy is not so bad, right? There is some robustness, there is a soft landing, but I think the way that when we talk about positioning for dollar weakness, it is precisely what we want to achieve, because we don't want a hard landing. We don't want extreme slowdown. We actually prefer a soft landing. And if you again recall, go back to the dollar smile, that is actually where the opportunity to be short dollar comes in. You don't want hard landing, you don't want US exceptionalism, you want something in between. And I think soft landing is actually the sweet spot over here. Again, I think if you look at the dot plot, which we would get a refreshed version next week, as long as the growth were to slow to a nice 2 to 2.5%, I think that is soft landing. Neutral rate can actually start to play out towards the 3% from where it is 5%. So we would be short the dollar broadly against the basket, but of course we like the Aussie, we like the pound, we also like the euro, and we like the Swiss franc. So I think the way to really play it is that you go a bit more broad-based. You don't concentrate on one single currency, but you just take a basket and you are short the dollar.
And for the yen? What are you playing?
Well, the yen, I would say that it is very volatile. So it would more be a range trading than a buy and hold strategy. For now, I think 140 is probably the bottom of the near-term range. It could actually bounce to 145, 147 if retail sales were to come in on the strong side. So I would actually be trading the dollar yen in this range rather than to just buy and hold, because there is also a cost involved if you hold yen for over 12 months.
I was disappointed at first because I agree with you on the dollar view, and it's no fun when we agree. It's much more fun when we can argue. But I think we've got a potential point of disagreement about the yen. I'm curious, in your yen view, what is your view on yen in isolation, taking out the dollar component, so yen on the crosses? Because I'm someone who fundamentally believes that the yen rally, I see it as momentum right now, you're not going to fight it, but I just don't see it being justified because I don't see self-sustaining inflation taking off in Japan. And therefore, I think that there's only a limited amount the BOJ can do. And I think the backdrop is a country that's still suffering from structural disinflationary pressures, poor demographics, poor growth. And therefore, I think at some point, and I have no idea when, the yen weakness trade, depreciation trade starts in earnest again, maybe later this year, early next year. What's your view on the yen?
Firstly, I would have to disappoint you by saying that we are still on the same page on this one. Because I think the yen story here is that I don't think the economics of it is justifying the hawkishness that we are hearing. The hawkishness is actually a bit of a self-imposed constraint because they were behind they are behind the curve. And they have to justify now to the parliament that why are they embarking on normalization. I think that is only the only reason why they are hawkish. As it is, I don't think the BOJ is bold enough to make radical changes. You see that even in their tapering program, very, very gradual. So I would say that the function of the dollar-yen decline that we are projecting is a function of narrowing rate differential and just extreme valuation coming into just a more normal state.
Tech, the yen aside, just wondering what other Asian currencies you see outperforming?
Yeah, I would say that in a cyclical market of US soft landing, better growth because policy rates are coming off, we would actually be liking more the North Asian currencies, not the yen for now, but we would be liking the Taiwan dollar, the Korean won, and we are also mindful that in the past 2 months, these are the laggards within the Asia space. You have the ringgit, you have the Thai baht that are up by about 8 to 9% over 3 months, but the Taiwan dollar, Korean won is just in the low single digit, partly because the equity outflows has been pretty strong over there. So I think as we were going into the later half of this quarter, I think the Taiwan dollar and the Korean won will actually be more interesting because there is a catch-up potential relative to what we have seen in the Thai baht and also in the ringgit.
Do you think for Taiwan dollar, Korean won, it's banking on what we potentially going to see from stock market inflows, but you also have these questions swirling still about the AI narrative. Do you think that is potentially a risk for what we're seeing in the currencies?
So just based on AI alone, we are structurally positive, even though we acknowledge that in the near term there could be noises, there could be export restrictions coming into the semicon space. So I think even on the AI side, we are calling for investors to be buying on the dips. And that extends to our positivity on cyclical markets like the Taiwan and the Korean won. Now, there are two parts of this story. One is the tech cycle, the AI factor and the inflows. The other part is also that these are the currencies, for example, the Taiwan dollar that was heavily shorted in the past 2 years. The local corporates, the local lifers are holding on to massive dollar exposure. And as the US interest rate attractiveness diminishes, they would actually be converting a lot of this exposure back to the local currency. So there is the additional factor of repatriation flows as well.
How much do you think stocks can actually run up if we see a 25 basis point cut from the Federal Reserve, which is our MLive question of the day?
Yeah, so I would say that it has to be in the context that we are getting a soft landing. Which would be cemented by the retail sales data. If the retail sales data is fine, it would be a 25, for example. And if that is the context, then the stock market would already be reacting to a soft landing scenario, which is higher equities on the 25. So it is not a 25 per se, but it is the context of the 25.
All right. Thank you so much for weighing in. It'll be a really interesting rest of the year. Teck Ling Tan of UBS Wealth Management and Bloomberg MLive Executive Editor Mark Cudmore. Thank you both.
All right, still to come this hour, our exclusive interview with Europe's largest software maker, SAP. We'll get their take on Asia's AI potential, plus Edelweiss Mutual Fund shares on their outlook for Indian markets. This is Bloomberg.
Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25-50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Bloomberg has learned that Couche-Tard is discussing improving its takeover proposal for Seven & I Holdings. It's aiming to convince the Japanese convenience store operator to start engaging in discussions. Our senior editor, Reed Stevenson, is with us now with more. So, Reed, considering the original offer and the response to it, one would imagine quite a considerable improvement is needed. What are we hearing?
Yeah, so far, what we've got is sort of a new phase here where Seven & I rejected the initial proposal from Couche-Tard. They disclosed the price of $14.86 a share, which Seven & I essentially said that they're willing to talk, but that's just too low to even begin discussions. And so the ball is sort of in Couche-Tard's court now, and what we're hearing through sources is that they are indeed considering a higher offer for Seven & I. We don't know what that number is. We don't even know what number Seven & I itself thinks the company is worth. But at least we're sort of in a phase now where we may get to see them go to the bargaining table. And then the question really is, how public is this going to be? Is this going to play out through press releases, et cetera? Or what's more likely, are they actually going to sit down and try to hash out a deal? And that's really the focus from here on out.
Well, we're just hearing that Seven & I has appointed Nomura to advise on this Couche-Tard offer. So we seem to be seeing that story moving forwards. We've seen the stock hitting a record, though, up 21% year to date. How much more upside is on the table here?
It's really hard to say. I mean, Seven & I has been in the crosshairs of activist investors for quite a while now. Essentially what they're saying is that, the company has a conglomerate discount. It's so sprawling that the true value of its business is not being expressed, namely in 7-Eleven, its convenience store network that now really spans not just Japan, but across Asia, and with more potentially to grow elsewhere. And so in terms of price, really that's just going to depend on how things work out. And it may not even be the case that, this is going to be a deal for all of Seven & I. If you recall, Seven & I spent more than $20 billion acquiring the Speedway gasoline station sort of retail network in the U.S. about 3-4 years ago. And to a certain extent, that acquisition has not been reflected in the share price. And maybe that's also something that Couche-Tard is interested in, which is a part of the business that, where it has a geographic footprint and experience. But really, all of this is very speculative. We're just sort of standing by to see, what is going to happen next in this very interesting saga in Japan, which, if consummated, would actually result in the biggest foreign takeover of a Japanese company.
Yeah, Reed, I was just going to ask, at the end of the day, it's really about helping to unlock value for shareholders, and we have the likes of Oasis saying that it's disappointed at Seven & I's response in rejecting the takeover proposal. So in terms of how long it can continue rejecting the advances, given what activist investors are seeking, what's your read on this?
Yeah, indeed. Seth Fisher said, here on Bloomberg Television earlier this morning that essentially Seven & I needs to engage more. Now, this is not new. We've had another investor, Artisan Partners, also say something very similar. But the other thing to note here is that, Seven & I is not just sort of constantly rejecting. It is making the right noises. It's saying, look, we're not telling you to go away. We're just saying the price that you have put forward right now is not even enough to sit down at the bargaining table. Give us a better price. So essentially the implication is, give us a better price and we're willing to sit down.
All right, our senior editor, Reed Stevenson in Tokyo there. Now let's get to another Bloomberg scoop. China has strongly advised its car makers to make sure advanced EV tech stays in the country, even as they build factories around the world. Our China correspondent Min Lo joins us now in Hong Kong. So, Min, what do we know about these government guidelines?
Yeah, so the Chinese Commerce Ministry had met with over a dozen car makers back in July, and they're asking the car makers to do two things. One is not to build full-fledged factories abroad. They want them to sell these so-called knockdown kits where you have key components still made domestically in China that allows China to use some of its pre-existing capacity and keep some of the jobs within China, and then assemble these parts overseas in plants abroad. And the second thing they ask car makers to do is not to export key EV technologies abroad. And this comes as many Chinese car makers are looking to make inroads in markets overseas amid this intense price war back at home. They can make better margins abroad, and they're also looking to localize a lot of the manufacturing to bypass some of these tariffs that are targeted at Chinese vehicle exports. So what is this going to do for plans for companies like Chery that is looking to open up a plant in Spain, BYD looking out to open up a plant in Hungary and in Turkey? It also poses a hurdle to some of these European countries that are looking to attract Chinese investments to build plants in their own countries to create jobs for European people and to boost their own local economy. So this is something that we need to watch in the coming months.
Min, what impact would this have on EV companies more specifically?
Yeah, so some of these companies have declined to comment, but BYD, for instance, they have committed to building a $1 billion plant in Turkey, for instance, that was supposed to employ about 5,000 people. But Turkey received special mention by the Chinese ministry. They're not saying don't invest there. They're saying let us know, inform the ministry first and inform the Chinese embassy in Turkey. Now, what would this mean going forward? The Chinese government is telling these companies that, look, don't blindly follow the trend to invest overseas, because many of these countries that are saying they're welcoming your investments are the same countries that are enacting or are considering to enact tariffs on Chinese vehicle exports. Turkey, for one, has said that they are imposing 40% tariffs on Chinese vehicle imports into the country. India also received special mention, the government calling on automakers not to make any investment in that country. And we know China and India has had ties strained for a number of years, especially after the standoff between the militaries at the Himalayas back in 2020. And just today, we got the news that India is hiking tariffs on Chinese steel as well.
All right, Bloomberg's China correspondent Min Lo there. Plenty more ahead. This is Bloomberg. Let's take a look at some of the names in the lithium space at the moment. Extending gains, we have had CATL confirming some changes to output. CATL planning to make some adjustments to its lithium carbonate production in Yichun, according to a company spokesperson. So they're curbing production at a major mine. And Aussie lithium stocks having a good day for a change. We got Minres up 7.6%. It's had a pretty wretched month. It's off about 15%. So on this news, maybe they'll start letting their employees out for coffee again. Similar story in the nickel and the uranium space as well. We've got shares of Asian nickel and uranium producers advancing. This is after Russian President Vladimir Putin asked the government to consider limiting exports of the commodity in response to Western sanctions. We've got deep yellow here in Australia, better by 11.5%. Still to come, Europe's largest software maker SAP says Asia's best place to become the world's most AI-enabled region. Their Asia Pacific and Japan president joining us exclusively next. This is Bloomberg.
Our technology and our infrastructure and software is really emotional for people because it directly affects their revenues, it directly affects their competitiveness. And so we probably have more emotional customers today, and deservedly so. And if we could fulfill everybody's need, then the emotion would go away. But it's very emotional, it's really tense. We've got a lot of responsibility on our shoulder, and we're trying to do the best we can.
Nvidia CEO Jensen Huang speaking at Goldman Sachs Technology Conference in San Francisco, highlighting their limited supply, strong demand, and how emotional some of the customers are getting. That's something that prompted the stock to soar 8% overnight, adding about $216 billion in market cap, a bit softer in after hours. But certainly the surge in Nvidia stock is something that dragged upward some of these Asian chip names as well. Take a look at what we're seeing in terms of the chip stocks in the region, where the likes of TSMC are among the biggest boosts to the region's stock gauge. It is a tech-led rebound today. Jensen Huang also highlighting TSMC as a company that it leans on heavily for production of its own chips, simply because in terms of market leadership, there is a very wide margin. Now, we're also seeing the South Korean and Japanese names among those that are gaining. Now, for more on the AI revolution and whether a chip shortage can slow things down, we're joined by Paul Marriott, President of Asia Pacific and Japan at software maker SAP. So, Paul, just thinking about this AI limited chip shortage, all these narratives coming in, along with concerns about some hesitancy towards whether this is going to provide more real-world applications. What is your sense of what clients are seeing and what you are seeing?
Yeah, it's interesting, to see Jensen's comments coming off the back of that. And, there's a $28 billion opportunity for AI across Asia. So it's absolutely real. The demand is there. But Avril, what I think is really important is how we ensure it's not what can we do with AI, but how are customers using it? And we see really three categories of where customers are adopting. So around employee productivity, improving the productivity of the overall workforce, overall process improvement across an organization, and also business model transformation. So we're seeing a significant adoption and SAP with SAP Business AI. It's all about partnering with the ecosystem and with our customers, to drive the highest value that they get from those AI and SAP investments.
What exactly are we seeing in terms of benefits for business and application? You correct me if I'm wrong, but I think in an interview earlier this year, your CEO did flag that in terms of AI solutions, one of it is how it can optimize the supply chains, make it reflect ESG criteria, but not affect profit at the same time, and that there would be some algorithms in the works towards that. Can you share with us?
Yeah, look, Asia is the supply chain center, of the world. And, for a long time, SAP has been providing our customers with supply chain solutions. We know that supply chains, are fragile, that we need to build more transparency and resiliency into what is a very complex and sophisticated combination of suppliers that bring together products and services that mean that the right product, arrives at the right place at the right time for a consumer. Easy to say, hard to do because of that complexity of the supply chain. But it's a huge opportunity for us here in Asia because we're the center of gravity of driving that. And where generative AI and SAP Business AI is really helping customers is around, improving the forecast accuracy of that supply and demand, looking at things like the logistics optimization, the warehousing, and really using data and these algorithms to optimize that complexity, to create more transparency, to create the resiliency, to create that agility in the supply chain that really fuels the opportunity for businesses in this part of the world. So I actually believe that's a really big area of value creation and opportunity for our customers to grow with generative AI.
Paul, of course, AI is only as good as its data set. How much of a problem is junk data, and what do you do to combat something like that?
Look, the SAP with Business AI has been really focused on the structured business data. Paul, 87% of the world's commerce is flowing through our SAP, our customers' SAP ERP systems. And that structured data that's in all of those ERP systems around the world has been very carefully and well governed over a very significant amount of time. Now, what cloud transformation and platforms like Nvidia and these very large compute platforms that allow us to take huge data sets in a very secure way and aggregate them. We have tens of thousands of customers that give us the anonymous use of their structured data to train these language models around finance, supply chain, HR, around customer engagement processes. And we have a very tightly governed set of models that is then allowing us to unlock the use of generative AI in our own SaaS solutions in a very relevant way, in a very accurate and reliable way, in a very responsible way. And we do that with data today that is already across those many thousands of systems. And Paul, the key thing there is the bridge to the public data. And I think you're referring to, to the public data, right, where there are definitely concerns around, security and policy and how that data is used and governed. And what we do at SAP is we create a bridge to that data to very carefully take the highly governed structured business data and connect that to the public data to get maximum value, from both the private and the public combination. And I really think that's a big differentiator in terms of how SAP Business AI and how responsible AI is driven from an SAP perspective.
One of the other themes that keeps coming up as well is around the question of profitability of AI and AI tools. How do you see revenue growth in that area currently, and do you see it accelerating?
Well, look here, you would have seen that coming off the back of our Q2 earnings ending June, we grew our cloud revenue by 38%. And if you look at all prior quarters, we see similar growth rate. That's above average growth rate for SAP globally. So absolutely, the infusion of AI and generative AI into business transformation and digital transformation is a significant opportunity. Paul, where we're really seeing, if I go back to the employee productivity, I was with Bank Danamon in Indonesia recently. They have 8,000 plus employees. They have 800 plus branches. And what they wanted to do with generative AI was look at how they accelerate the recruiting process to get the best talent into their organization, but also then for all of the talent that they manage, how do they accelerate the growth and capability of their workforce? And through our SAP SuccessFactors SaaS solution, where we embed the AI scenarios around recruitment, around development of employees, they're able to switch that innovation on very, very easily in a very low risk way to enable that business value in their organization. And because it's all in the cloud, that's available to all of the customers immediately that are using our SuccessFactor platform. And it's the same across finance, supply chain, and our customer solutions. Another customer in your part of the world, CITIC Pacific, the mining industry for Australia is obviously a big one. And in that sector, for example, the safety of employees is paramount. And there's a lot of process, there's a lot of documentation around how you ensure the safety of your employees. And we've worked with CITIC Pacific to look at how they use generative AI around those processes to not only increase the safety of their employees, but they talk to hundreds of thousands of dollars, in fact, 400,000 Australian dollars benefit in terms of the savings around delivering that safety process within their organization. So there's no doubt an economic benefit to the scenarios that we're seeing around whether it's workforce productivity, process improvement, and right through to business model transformation.
Paul, on the AI front, how are you keeping up with some of the competitors in the US and in Asia? Maybe, given how it's headquartered in Germany, are you seeing potentially the tighter EU regulations as a bit of a complication?
I think, well, look, firstly, how do we get as close as possible to the customers in this part of the world? Because I really do believe that AI leadership out of Asia is an opportunity for SAP and for all tech companies. And the way that we really bring our engineering and our capability close to the region is through our SAP development centers through our labs. A couple of years ago, we opened up here in Singapore. Proud to say we have 350 plus AI experts right here in Singapore, building and engineering things like our manufacturing cloud with generative AI, which also gives direct access for our customers in this part of the world, to understand and partner with us on these technologies. And we actually have 5 of these labs in the region. The biggest one outside of India sits outside of Germany. Sits in India. It's 14,000 engineers. We have a lab in Japan. We have a lab in Korea, and we've just announced the opening of a lab also in Vietnam. And I think this is linked to this $1 billion investment that we announced at the beginning of this year of how do we transform, how do we develop our own skill sets with generative AI. But for Asia, how do we bring that close to our customers so that we can have the fastest and best impact to the customers that are at the heart of the supply chain? So, yep, absolutely. We work with Nvidia. We work with Microsoft, AWS. It's a partnership model as well. So in collaboration with those partners, we really drive scale, in this part of the world.
All right, Paul, we'll leave it there for today. Thank you so much for coming in and sharing the plans of the business with us. Paul Marriott, Asia Pacific and Japan, President of SAP. Now let's check in on how 7&I shares are faring. Of course, we're back from the lunch break, and as we headed into it in the morning session, just before we saw the stock surge about 7%, hitting a record high. This was after what we heard about Couche-Tard reportedly looking into a higher price proposal for 7&I, and indeed, we've also, during the lunch break, heard how 7&I is looking to Nomura to get some advisory there. So coming back from the lunch break, we're still seeing 7&I stocks pairing some of the gains from earlier on in the session. Paul.
Still to come, Edelweiss Mutual Fund shares their outlook on Indian markets. Hear which sectors they're looking at next. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching the India Focus. We're just under 2 minutes away from the open in India. Here's a look at the pre-market. Looks like it's going to be a modestly risk-on day. Well, let's get to our next guest now, Radhika Gupta, MD and CEO at Edelweiss Mutual Fund. Radhika, thanks so much for joining us. Of course, we are getting some important data out of India later on tonight. CPI numbers, we're expecting that to slow a little bit more in the month of August. What are you observing in terms of price pressures in India, and when do you expect the RBI to start easing?
So I think an RBI ease is on the cards. Given that you're going to start seeing rate cuts in the US, at least our view is that India is not going to be left too far behind. The question is, one cycle or 2 cycles later. I don't think inflationary pressures have been out of control in the Indian context. I think in a period where the world has seen meaningful inflation compared to historical numbers, India hasn't been so bad. But the reality is that, I think we will fall in line with global trajectory on this.
Radhika, as you just mentioned, the Fed is expected to ease overnight. We got US inflation numbers as well, and that caused traders to pare back their expectations of a 50 basis point cut from the Fed next week. In the event that we see 25 basis points, what is your sense of how much further we can see a run-up in stocks?
So I think, you'll continue. So Indian markets, of course, have been a strong performer this year. And I think high interest rates in the US have been one of the reasons that you've perhaps seen more subdued global flows into India than is warranted. India has seen a time where domestic flows have been exceptionally strong. Global flows have been, I think, a little less muted than they should. If you start seeing rate cuts in the US, I think emerging markets and certainly India become a little more attractive. Some of that, I think, is priced in, but I do believe there's some global money waiting on the sidelines, and I think a rate cut will only help.
Okay, given where valuations are you pushing more towards large caps, though, versus maybe small and mid
So I think that's a fair question. If you look at the large cap index on a 1 year forward basis, it's at 21, 22. It is still more fairly valued. I was just looking at some data yesterday. Even on a large cap basis, on a 10-year rolling basis, the PE multiple of Indian equities has continued to trend up. So India continues to get re-rated upwards. But within that context, I think large cap seems in a healthier space. As you move to the small cap end of the curve, would you go out on a limb and say stocks are cheap? No, they're not. I think at multiples of 27, 28, small cap stocks are certainly not cheap. I think the market, however, will continue to reward mid and small caps till they can demonstrate the kind of earnings growth that they are. Where we see individual stocks having a growth mix or a growth disappointment, with these kind of multiples, I think the market is punishing them very, very hardly. So we are certainly a lot more selective in our approach to mid and small caps, given the valuation trajectory. And there's certain pockets where we do see exuberance. I mean, I'll give you an example: private sector defense, for instance.
Considering the incredible run-up that we've seen in Indian equities more broadly, though, do you add to positions now or do you wait for pullbacks?
It's a hard market if you are waiting for pullbacks, and there have been a lot of investors in India looking for corrections and sorely disappointed. In fact, this has been a year of meaningful number of events, whether it was an election outcome, whether it was an increase in capital gains tax. But flows have been so strong, particularly on the domestic side, that every bit of cut in equities, I think, has been met by equal amounts of buying. Our advice to investors is that if you're taking a 10-year outlook on India and you tend to be more biased towards the large and mid-cap space, you can continue to deploy in equities, because we do see double-digit earnings growth continuing to be a reality over 10 years. If you're looking to take extreme bets in the small cap space, perhaps you need to wait for the pullbacks. But if you're taking a 10-year view on the top 200 companies in India, I think trying to time it is a difficult thing, as this year has proven.
What's the impact of mutual funds been as well? Because we're seeing India's equity culture sort of spreading beyond the city into that area. What potential do you see for that share of the market to grow?
I think financialization, what you're seeing in India, is a natural course of economic growth. It was, again, going back to some data on the US, and when the economy expanded from this 4 trillion to 8 trillion journey that India is just about doing, mutual fund AUMs in the US grew by more than 20 times. And I wouldn't be surprised if the same story picks up some pace in India, as it is already picking up. If you look at the new generation Indian, the younger Indian today, the younger Indian of 20 years ago started by making their first investment in a bank deposit. Today, the younger Indian starts by making their first investment in a monthly investment plan through mutual funds, because they see the story of Indian equities. And I think the equity investment culture is a larger part of risk appetite increase in India, whether it is the startup ecosystem, whether it is the equity ecosystem, it all comes together. I still think, however, the numbers are very, very low. If you look at mutual fund AUM to GDP in India, it's a paltry 16%. The world average is now sitting at 80%. So while we've seen a lot of success, we still have a lot of headroom to go. We are 5% of world GDP. Our mutual fund AUM is not 1% of the world. So while we've made progress, a lot of room to go.
All right, Radhika Gupta, MD and CEO at Edelweiss Mutual Fund. Thank you so much for joining us. Well, India's been trading now for a little more than 5 minutes. Let's take a look at how we're tracking at the moment. We're seeing stocks moving broadly higher. The Sensex index better by 1/3%. We've got the Nifty Bank Index better by 0.4%. The rupee still hovering around those record lows. And of course, as we mentioned, we are awaiting CPI data out of India in a few hours' time. All right, plenty more to come. This is Bloomberg. Here's a look at European futures at the moment, also moving into positive territory. It is a risk-on day across the Asia-Pacific right now, and we do have also an ECB rate decision coming up. The European Central Bank will be delivering that decision later on today. Economists do anticipate a quarter-point cut. Bloomberg's Tom McKenzie joins us now from London. So, Tom, easing expected here, but what risks remain around inflation in Europe?
Yeah, guys, look, absolutely. The focus less, arguably, on the rate cut that is fully expected by economists surveyed by Bloomberg, more, arguably, on what Christine Lagarde, the president, of course, of the ECB, is likely to say in her press conference, and also, as well, scrutiny of the forecasts around both growth and, as you say, inflation. The inflation dynamics in Europe are thus 2.2% in August. Bloomberg Economics expects the inflation picture on a headline basis to get to the target, the ECB's target of 2%, by the second half of this year. So on a headline basis, inflation is firmly on track for this European Central Bank. You lift the hood, though, and for some of the hawks on the ECB, the concern is around services pricing and wages as well. Now, some of that has come off, but there is a stickiness around services. There's a stickiness around wage growth. So that will be scrutinised as well in those forecasts. But again, expectations, you get the second cut of the cycle coming through after the first cut in June, of course, bringing the rate down to 3.5%. The market's pricing in about 60 basis points of cuts from the ECB, including today, to the end of this year, guys.
All right, Bloomberg's Tom McKenzie there in London ahead of that ECB decision. And you can stay with us for our live coverage of that rate decision and President Christine Lagarde's press briefing afterwards. That is coming up 8 p.m. tonight if you're watching in Hong Kong. Also, we're going to be watching in the next couple of days, Avril, a bit of history being made off-world. SpaceX launched from Florida today. A Crew Dragon capsule, 4 private astronauts aboard, including the billionaire Jared Isaacson, who's paying for the whole thing. And they're going to be doing a spacewalk, the first one by a private crew, and a tremendous amount of risk involved in this as well.
Yeah, so these individuals certainly very brave in taking this journey into space. As you say, they are private astronauts. Makes you kind of wonder the extent in which this will kind of fuel more of such journeys among private individuals, Paul.
Yeah, it sounds fairly terrifying. The Crew Dragon has no airlock, so when they open that door and 2 of the astronauts go for that spacewalk, the entire capsule is going to be exposed to the vacuum of space. What could possibly go wrong? There is a new nitrogen repress system that'll restore cabin pressure after the spacewalk, but the suits have never been used in space either. So a whole lot of firsts here for that crew on their way to do that historic spacewalk. Okay, let's take a look at how markets are tracking. In short, risk on day across most of the region. The Nikkei now better by more than 3%. We've got the Kospi performing quite strongly as well, better by 1.6%. This is after, of course, we had that slightly hotter than expected CPI print out of the US. Market now anticipating we'll be getting 25 basis points of easing from the Fed this month. And that is it from Bloomberg Markets Asia. Horizons in Middle East and Africa up next. This is Bloomberg.